Instead of talking about tech stocks today, we're gonna switch it up a little bit and talk about John Deere. We'll go over a number of different metrics behind the business, including EPS, as well as revenue and shares outstanding. And we'll take a look at how some of these numbers have compounded over time. And I'll give my opinion on what could happen over the course of the next few months that could be a good entry point into this stock. So if you enjoyed the video, drop a like down below. And if you wanna see more videos like this one, make sure to subscribe. When I first started looking into John Deere, I noticed something interesting about their stock price. They had a giant run up in 2020. However, since then, the stock has been trading sideways for about 3 years. However, over the course of the last 5 years, the stock is up almost 150%. Even though the stock price has traded sideways for the last 3 years, their top line revenue numbers have increased significantly. Back at the start of 2021, they were bringing in around $37 billion of trailing 12-month revenue. That has grown all the way up to $60.7 billion of trailing 12-month revenue. And EPS follows a very similar trend. Again, at the start of 2021, they were bringing in around $10.93 of trailing 12-month EPS. However, that has exploded all the way up to $34.31 of trailing 12-month EPS. So there appears to be a divergence between how John Deere's stock price has performed over the course of the last 3 years and how their business has actually performed. And the biggest explanation for this is likely that investors anticipated this growth in 2020 and began pricing it into the stock ahead of time. If we zoom out and look at John Deere's stock price over the last 20 years, we can see that there are a number of periods of time where the stock has traded sideways for 3 to 5 years. We see that in 2017 through 2020 where the stock traded sideways around $150, and then we see that again in 2011 all the way through till 2015 where the stock traded sideways. However, this tends to be a stock that isn't held down for long. If we look at the last 20 years from 2004 till now, the stock is up over 1,000%. And John Deere's business model is not going away anytime soon. They are providing farmers with tractors, mowers, planters, any piece of farm equipment that you can imagine. And this is equipment that over the last 10 to 15 years has advanced in a very significant way. They are now making tractors that drive themselves around the fields that are mapped by GPS and where the farmer does not need to be very involved. And as this equipment advances in technology, there is less ability for the farmers to work on it. This will require more parts and more services from John Deere and help them expand their business. As these equipment break down, farmers will no longer be able to work on it by themselves. They will need a technician from John Deere to either come out or actually send the equipment into John Deere for service. And even with all of that, John Deere is offering their own financing to farmers. So they have a one-stop shop for farmers to come in, buy equipment, get it financed, get it serviced, and really keep these farmers in their ecosystem of using John Deere products. And that is going to be massive for the company moving forward and growing the economics behind the business. And some of this change in John Deere's business model should have a positive effect on smoothing out some of the cyclical nature that we see in their revenue. Back in 2014, they were going through a bull cycle where their revenue spiked up, and then it gradually sunk back down, spiked up again in 2019, and then saw another dip, and we're kind of seeing it spike up again in 2023 and start its dip cycle here at the end of 2023. However, I think that this dip will be less severe than what we saw back in 2016, where revenues fell year over year by around 25%. And the smoothing out of these metrics should also affect John Deere's valuation. When investors see businesses that go through a very cyclical nature, they don't like to price it at a premium. They tend to price it around a 10 to 15 PE ratio. However, if John Deere can get to a built-out ecosystem where they have more consistent revenue growth, I believe they could command a higher valuation, potentially in that 15 to 20, maybe even 20 to 25 PE ratio. Currently, with the uncertainty around if John Deere is going to go through a down cycle over the course of the next couple of years, the valuation for John Deere has kind of been all over the place. We can see that in October, it was sitting around 11.27. However, a year ago, it was sitting at a 15.13, and then currently it's sitting around a 14.39. And here we can see their PE ratio actually trended over time. The top is price, the middle graph is EPS, and then down below we have PE ratio. And we can actually see in 2020 how this kind of valuation and why the stock has traded sideways over the course of the last couple years. And it has to do with the fact that that the PE ratio spiked up in a major way throughout 2020, all the way up to a PE ratio of around a 25. And that means that the stock was trading at a premium because investors were anticipating this growth in EPS that we saw. However, over the course of the next couple of years, because valuation needed to trend back down to where it historically had been at, the stock price basically has traded sideways, even though EPS has ran up in a major way. And the only thing that's a little bit scary with John Deere is analysts' expectations around where EPS could be headed over the course of the next 2 years. They have an average EPS estimate for 2024 of $27.29. This is down year over year from $34.69. And they expect it to rebound slightly in 2025 to $27.61. That means that PE ratios for this year and next are anywhere from a 12.35 all the way up to a 17.12. If we take the average EPS estimate for this year, we're looking at a forward PE ratio of around a 14.03. And if we assume that John Deere is going to trade at a PE ratio ranging between 10 to 15, that means the stock price could potentially fall 30% to a price of around $272, or it could go up slightly to a price of around $409, or about a 7% gain. However, even with this potential drop in EPS, John Deere is still a very stable company. They have a dividend right now of $1.47, and the last time they actually cut this dividend, you have to go back to 1986 when they cut it from 2 cents down to 1 cent. And dividends aren't the only way that they have increased shareholder value. They have had a strong focus over the last 10 years on decreasing their shares outstanding. And most recently, they have seen a year-over-year decrease in shares outstanding of 6%. And I want to highlight some of these metrics because they are very impressive. In terms of price, John Deere has been able to grow their stock price from 1994 to 2024 by 11.41% year over year. Compared to the S&P 500, it has only been able to grow by around 8.35% over the same time period. On top of that, John Deere has been able to increase their dividend over time. And from 1986 through 2023, they have been able to increase their dividend by 14.42% year over year. Revenue growth hasn't been anything amazing over the course of the last 10 years. They have been able to grow their revenue from around $38 billion to $60.8 billion, which is a 4.81% growth year over year. However, even with that slow revenue growth, they've been able to grow their EPS numbers by about 14% year over the course of the last 10 years. And one of the ways they have been able to do that is by decreasing their shares outstanding consistently. Over the course of the last 10 years, they have been able to decrease these shares by about 2.84% each year. So currently, John Deere is not a stock that I own. However, it is one that I'm potentially looking to add to my dividend portfolio. However, one thing that I want to keep an eye on is their next earnings date. This is a big quarter for them. Generally, the earnings during this time period is the strongest that they see throughout the year. And I want to see if they continue to grow these numbers year over year, or if analyst expectations are coming true and the stock is going to see a reduction in EPS numbers over the course of the next year. And right now, analysts are expecting $7.82 in this quarter. However, keep in mind that over the course of the last 5 quarters, they have been wrong by anywhere from 10% all the way up to 25% on EPS estimates. So right now for me, John Deere is just a company I am going to watch. I think if it falls into that kind of $350 range, I may pick up a few shares in my dividend portfolio just so I constantly am looking at it and watching the stock. And if it were to dip even further, I would be potentially interested in loading up more. I think this is a company that long term is not going anywhere. They have proven that the company and the metrics behind the business that they are focused on, they are able to grow over time. And that I think is very important because over the course of the next 30, 40 years, I don't think John Deere is going anywhere. I think that they are going to be increasingly more and more important in the types of equipment that they are coming out with and the services that they are providing to farmers. But do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. So with all that said, I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to hit that sub button. And as always, guys, have a wonderful rest of your day.